Hi guys, welcome to my investment monthly review for December. Today I will be going over a year-end review of my investment portfolio, as well as a warning against DCA, dollar cost averaging. So let's get started. The return in December of my investment account was negative 2.5%. In December, I sold IBKR and QLD and added some shares of Amazon, Google, and LLY. The current cash allocation in my portfolio is 20%. Here is a comparison between the returns of my account, SPY, and QQQ. Note that the total returns this year, since the beginning of this year, for my investment portfolio is 47.8%, around 48%. Meanwhile, SPY and QQQ each have returns around 25%. Also, since the beginning of my investment account, since June 2023, I have had the total return of 74.8%. In contrast, SPY and QQQ during that same time period have had returns of 43.6% and 49%, respectively. So now let's move on to talk about dollar cost averaging. So what is dollar cost averaging, or DCA? Dollar cost averaging is an investment strategy where an investor divides their total investment account amount into equal parts and invests these fixed amounts at regular intervals, regardless of market conditions. Some key features of DCA is that number one, it has systematic investment. So in other words, it allows you to invest at regular intervals, for example, weekly or monthly intervals. Number two, it has risk mitigation. It reduces the impact of market volatility by avoiding lump sum investments. Additionally, it focuses on quantity. More shares are purchased when prices are low, and fewer shares are purchased when prices are high. Fourth, it allows for emotion-free investing, and by using dollar cost averaging, you avoid the psychological pressure of trying to time the market. And finally, dollar cost averaging is ideal for beginners. It is suitable for new investors who want to start investing but have limited knowledge and are afraid of timing the market wrong. So now, before we talk about why dollar cost averaging could be risky in today's market, it would be nice to understand what the stock market currently is like right now. Currently, the S&P 500 price to earnings or PE ratio ranks about above the 99th percentile of historical levels, strongly suggesting that the market is highly overvalued. And if you look at the above picture here, or the above graph, which is the graph of the S&P 500's P/E ratio over the years, you can see that right now the P/E ratio currently 30.33 is way higher than the majority of P/E ratios in the past. This suggests that a market correction of more than 20% may occur within the next 6 to 12 months. So now let's see how dollar cost averaging is risky if we start to invest 1 year before two latest stock crashes. So let's start with an experiment. We will implement dollar cost averaging DCA on SPY by starting investments 1 year prior to the stock market peak of the dot-com bubble in August 2000 and continuing until the market's lowest point in September 2002 to see how dollar cost averaging how that strategy will perform in large stock crashes. So note that the time period for this is from August 1999 to the September 30th, 2002, with an initial investment of $1,000 on August 2nd, 1999. DCA time, which is the end of every month. The frequency is monthly, and the DCA amount is $1,000. So you can see the total return of this period, if you had used dollar cost averaging, is negative 31.6%. Meanwhile, the total return of SPY was negative 35.9%. So you can see these two losses are around the same, showing that dollar cost averaging really doesn't lower the risk or losses you get in a market crash. You can see to the left is the graph of SPY during this time period. So here you can see that the DCA is really not very effective in before these stock market crashes. So now let's do a second experiment. Now let's try implementing dollar cost averaging 2 years prior to the stock market peak of the dot-com bubble on August 2000 and continuing until the market's lowest point. So the time period for this experiment is from August 3rd, 1998 to September 30th, 2002. Where the DCA time, DCA frequency, and amount stays the same. So what do we get? Well, turns out the total return, if you had used DCA for this period, would have been negative 30.7%. In contrast, the total return of SPY was only negative 22.7%. So if you had used DCA starting from 2 years prior to the stock market peak of this market crash, you would have had bigger losses than if you had just invested in SPY uh, at once, starting from August 2000. And now let's try seeing how dollar cost averaging would perform if we started investing 3 years prior to the stock market peak. Then the total return of this period would have been negative 27.4%. In contrast, the total return of SPY would have been negative 15.9%. So what does this show us? This shows that dollar cost averaging performs even worse than if you had just invested once for a single time in SPY. In fact, using DCA, you would have had vastly bigger losses. And so now you may be wondering, well, what if it's just this example? So let's try with another stock market crash. This time, let's implement dollar cost averaging on SPY starting 1 year prior, but this time to the stock market peak of the subprime mortgage crisis on October 2007 and continuing until the market's lowest point on February 2009. So the time period for this experiment is from October 2nd, 2006 to February 27, 2009. Again, we have an initial investment of $1,000 on October 2nd, 2006, uh, a DCA time at the end of every month, frequency, which is monthly, and the amount is $1,000. So you can see from this period of time, you would have, if you had used DCA, you would have had a return of negative 40.2%, while the total return of SPY would have been negative 41.7%. So these total returns are very close, suggesting again that dollar cost averaging doesn't help much in stock market crashes. Now, if we had increased the experiment time by another year, so starting 2 years prior now, we would have had this same result as in the previous experiment with the previous crash. This time we would have a total return of negative 39.7%, which is an even bigger loss than the total return of SPY if you had just invested in a single try, which would have been negative 35.6%. And finally, if we started using dollar cost averaging 3 years prior to the stock market peak of the subprime mortgage crisis and continuing until the market's lowest point. So this time starting from October 1st, 2004 to February 27, 2009, then you can see we would have a total return of negative 38.1% if we had used dollar cost averaging. In contrast, the total return of SPY without using dollar cost averaging would have been negative 29.1%. So you can see from this example, if you had used the dollar cost averaging a few years before a stock market crash, you would have had even greater losses than if you had just invested in SPY for a single time without using dollar cost averaging in the normal way. This shows that dollar cost averaging does not help in stock market crashes and even will give you huger losses. So how does this apply to us? Well, since from the previous slides, I have shown you guys that the stock market is very likely to crash or receive a pretty big correction in the next few years. Then this is why dollar cost averaging could be very risky in in today's market if you started using that strategy now. So how can you solve this? Well, you can use my midterm market direction model. This, by the way, is also used in the market analysis and operation fund meetings. So you can see from this graph here that the blue line is my market direction model. You can see that using a set of internal algorithms. It can predict the crashes of SPY and prevent major losses. Like, for example, here, here, and here, for example, you can see the standard deviation of my model in the blue line plotted here is 10.7%. The worst year is negative 19.87%, and the max drawdown in this period of time is negative 21.6%. In contrast, you can see from the yellow line here, SPY's standard deviation is 15%. Its worst year has had a loss of negative 36.81%, and the max drawdown was negative 50.8%. So using some internal algorithms, which I won't mention today, my market direction model basically predicts the current midterm market direction, and based on that, either buys or holds SPY or sells SPY. And you can see the difference between this blue line here and this orange line here. So what I will do is, starting from right now, as of December 31st, 2024, I will, every meeting or every video, I will share the current market direction based on my market direction model. And you can follow along with me as I either buy or sell SPY based on this model. By the way, the current market direction as of December 31st is bullish right now. So overall, this is the end of this month's, or actually this year's, stock investment monthly report. Thank you all for following along with me and watching my videos. If you have found my videos to be beneficial, please like and subscribe and recommend these videos or recommend my channel to others. But anyways, again, thank you all for watching my videos and supporting me, and have a happy new year. Bye.